So the German poet Goethe says, we see what we know. The Canadian philosopher Marshall McLuhan said, we don't know how water was discovered, but we know the fish didn't do it. I don't have any fish jokes, but remember the fish analogy. It's very important for the rest of my presentation today. The markets are the fish. And the structural secular forces that are most important that surround them are often invisible and ambient, unless something reprices it. By then, the alpha is gone and the beta changes. This, in my view, is the past, present, and future of markets. In markets, is my belief, there's always been a gap between what was a reality and what is already forming in the water. Markets, in my opinion, tend to notice last, but market builders notice first. They build the capital structure, the capital vehicles that bridges this new reality to returns. That is basically the content of this afternoon. And my goal and our goal is to introduce you to market builders and let them tell their story. Every era has market builders, from those that created the joint stock company to those in endowment world that created the 60-40 portfolio. The alpha, in my opinion, doesn't go to the smartest analyst of beta. It goes to the architects of new vehicles. Capital structures have consistently lagged the economic reality they were built to finance. The joint stock company emerged after a 100-year normalization of long-distance Asian trade that already became continuous. The industrial bond matured pretty much when the railroads were already built. But it is in this window of rising economic value and lagging financeability that durable alpha was formed. The joint stock company reduced the binary risk of single voyages, aggregated multi-year, multi-ship expeditions, and enabled secondary transactions. Alpha was created. The industrial bond allowed for wider loan syndications, longer maturities to match the asset life, and enabled less fragmentation of tracks. The first unicorn in America was born. Installment financing, dealer credit, was a capital structure innovation that converted latent demand into realized industrial earnings and production coordination. The early 70s were perhaps the most recent regime change for markets. When Nixon took us off the gold standard, he enabled leverage. We went from $3 trillion to $300 trillion in debt, and the mortgage finance market and the securitizations scaled. Moore's Law, which Nixon lived through, or the birth of, led to the advent of the fit-for-purpose instrument and asset class that we now call venture capital. Nixon's sort of approach to China birthed globalization, trade finance scaled. And the boomers, the demographic dividend, led to a brand new savings model of modern portfolio theory, ETFs, and $13 trillion of passive investing as we know it today. Across 3 centuries and 4 economic resets, the pattern has not bent. The shifts were always visible. The emergent economic reality was always visible. The vehicles were always missing, and the alpha belonged to whoever built it. We believe the next reset is underway. The 4 transitions that defined the 1970s led to the birth of the intangible economy. We went from 17% of the S&P in 1975 as intangible assets to now 92% of the S&P. That intangible economy led to the growth of financial services, the growth of levered asset classes like private equity and infrastructure, consumer-led, debt-fueled consumption, globalization, the rise of China, and the depletion of the fixed asset base of the West. we effectively transitioned our tangible economy to the emerging markets. Obviously, computation, innovation, power law were born with many parts of our economy. The next 30 years, I believe, requires an entanglement between the intangible world and the physical world. We already know about the physical bottlenecks of AI, but geopolitical chokeholds and supply chains, the need for deflation, whether it's healthcare, whether it's reindustrialization of supply chains, and obviously the risks of 2.5 degree heating it has on every single aspect of calories, electrons, energy density, and water. I believe for the first time since the 1970s, we are seeing a similar, instead of 4 in the 1970s, we're seeing 5 since COVID. AI, multipolar world, a declining price of money to an unknown price of money, 1.5 degrees to 2.5 warming, and we're going from a demographic dividend to a demographic headwind. This will shape the new economic reality. We believe these 5 forces will sort of rewrite sort of the ingredients of economic growth. These 5 forces will change beta. Every structural force on this page represents a paradox. The thing that led to the source of the next decade's constraint is also the source of its returns. And many of you are working on the source of returns in terms of the frictions that these 5 transitions represent. This shift to the physical economy is not a single phenomenon. It will impact macro, industrial, and operating reality. Commodities, farmland, energy were treated as hedges against equity drawdowns. Now you can think of them as inflation and currency uncertainty and make them a return engine. And now the choke point is potentially the asset. We believe these 5 forces will lead to 4 shifts. The AI revolution, in my opinion, is eventually a physical revolution as much as a computational one. We need supply chains that are not inflationary to reshore and have durability. And we believe returns belong to those that lower the cost of essentials, food, energy, transport, healthcare, and have pricing power linked to inflation. And market share, we believe, will go to brands and platforms that have trust, efficacy, sustainability, and a supply chain advantage. We know this shift is changing demand and supply. Some people call this the volatility premium, the reliability premium. I've also heard it referred to as sort of the chaos premium. And even markets, i.e. our fish, is seeing the changing water. So what are the pockets of alpha? Where is this new reality, this new economic reality based on these 5 forces? Where is it rising in economic value but lacking in financeability? What is yet to be built? We call these like riches in the niches. I love that word. So I like use it. I know who gave it to me, and I should probably give him a trademark or something. So whatever the source of shift, today's niche could be tomorrow's scaled market winner. In 1985 to really maybe 2005, shale was considered a niche. Now it's the thing that's preventing an energy shock that's more impactful for the US. And many of these examples started off as a niche that was easily dismissed, but there was financing that occurred and financing vehicles that scaled it. So what is the algorithm to alpha? In our view, it takes real demand signals, a proven economic model, but a market that is viewed as too complex or too small. So we believe that underwriting the complicated is really important to financing the capital gap between the rising economic value and the financing lag. These shifts are in plain sight and have economic proof, from regenerative agriculture to energy storage to automation to new generation of shipping. Every prior reset, the 4 resets over 300 years, had the same complaint with the emerging asset class: wrong duration, wrong vehicle, wrong risk frame, and wrong scale. every prior reset, those 4 complaints were also design features for the capital that won. Again, reality is found, not built. I believe financeability is built, not found. We need a capital solution mindset, not a check the box mindset, and the winners will be in the seams. We're obviously focused on fit for purpose capital. That is the theme of this afternoon. The last 30 to 50 years rewarded the intangible economy. This reset, these 5 core sector themes we're building our firm around, we will reward the physical, the less volatile, the less inflationary, and the more durable. So this is 20,000 words. Hopefully you're not confused still. If you are, you can read it. My colleagues and I put together this report that is a deeper version of what I just presented to you.